Good afternoon, everyone, and thank you so much for joining us on today's webinar, From Risk to Resilience, Leveraging Technology for Financial Compliance at Your Credit Union. My name is Danny Coley. I am the Director of Marketing here at Loan Vision, and today Loan Vision and Richey May are going to discuss the mortgage accounting tools that your team needs for success, and how to implement them from a compliance perspective, and how to safeguard your systems and manage those risks. As a quick intro in for all of my team here today, or I'm sorry, I did skip through the topics there that we'll speak on, and we can go back into that after introductions, or we can start there, start again. What we'll cover 4 primary topics across the span of the webinar, which include everything from evaluating your accounting software and processes to implementing the tech needed from a compliance perspective, and then going into any security and third-party risk considerations that could lead into that it will be fueled by the Q&A with the experts. So if we go into the introductions of who we have speaking on the call today. Again, my name is Danny Coley. I'm the Director of Marketing here at Loan Vision. I've been with the organization just over 6 months now, and my primary responsibilities are to lead the marketing function of our go-to-market team, which includes everything, but it's not limited to demand generation strategy, pipeline budget and forecasting, vendor partner management, and our Loan Vision brand strategy. Next, I'm pleased to introduce Kim Dittmer, the Director and Practice Leader of Outsourced Accounting at Richey May. With over 25 years of experience in corporate finance consulting and public accounting, Kim is a key asset to her clients. And as the practice leader, Kim specializes in providing tailored outsourced accounting and advisory solutions to the mortgage banking industry. Next, we have Mignon Davis, who is Richey May's Director of Risk and Compliance with over 20 years of mortgage industry experience in a variety of roles, including mortgage servicing, default servicing, and servicing quality control. She has an extensive experience in compliance and internal controls, risk management, and operational processes within the industry. Mignon also serves on the MBA's Loan Administration Committee as an instructor and for the MBA School of Mortgage Servicing. And finally, we have Michael Nugier, is Richey May's Chief Information Security Officer and Director of Cybersecurity Practice. So with over 15 years of experience providing enterprise information security and risk management services to various organizations, anywhere from mid-market to enterprise, largely in the financial services industry. Michael creates sustainable change for his clients by focusing on their overall business priorities and current state of security to build customized cybersecurity strategies, which lead to stronger adoption of practices and long-lasting success. So just a couple of quick housekeeping things before we dive into the webinar and I hand it off to our team. As a reminder, we are recording this call, so it will be emailed out to all attendees within the next 1 to 2 business days for those who want to watch the playback or for those who couldn't make it today. And, excuse me, as a reminder, all attendees are muted, but we do want to encourage this to be interactive. So if you have any questions, we encourage you to drop those in the designated Q&A chat. We will be moderating those throughout the span of the webinar, and then we will do our best to address all of those towards the end of the webinar. If we have no other questions, without further ado, I will hand it over to my team, starting with Kim Dittmer.
Thank you, Danny. Hi, everyone. Good to be here today. So I'm going to start off by talking a little bit about evaluating your accounting software and the processes that go along with that software. So really, first and foremost, it starts with good financial reporting. So we always like to say, begin with the end in mind. So the goal of any good accounting system is to make sure that you have the data needed to create good financial reporting that can drive sound business decisions. That really starts with being able to track exactly what you want to measure and being able to report on. So in terms of the mortgage industry, a lot of our clients really struggle here. They come to us kind of asking, how do we evaluate our business, make decisions, and impact profitability? And it really does start with getting the data to the lowest detail level possible, particularly when it comes to your mortgage accounting. Getting that data into your accounting system so that you can facilitate, drilling into the details, tracking the things and the metrics that are important to your business that can help drive those decisions, and really producing timely reports. The ability to act quickly is paramount, especially in this mortgage market. So putting reports into the hands of those who can make those decisions quickly is very key to kind of getting that financial reporting where it needs to be to drive the business. So what does it mean to have the right financial data? When it comes to mortgage loans, it's really about getting all of the details in your system to the extent possible. So if we switch to the next slide, Michael, we have really getting down to the details of your borrower data. We call that a loan card or a borrower data card, a loan data card. Ultimately, anything that exists in your loan origination system should be able to, come into your accounting system and allow you to track very specifically different characteristics on your loans, all of the loan activity that is impacting your general ledger. Ultimately, you want to get that data into the system at a loan level. That means loading all the loan characteristics, all the borrower data, everything that impacts your financials from your LOS system into your accounting system. Not only does it require good loan characteristics and loan data, but also pulling in invoice details. So the loan card data will inform all of the important things that you want to know about your loans, but also it's very important to track the expenses related to each loan. So pulling in invoice details, working with your vendors to get invoices at a loan level so that you can import those those invoices ultimately into your general ledger and be able to track expenses for each individual loan. Ultimately, a few things that are critical for success here: coordinating with your operations team. So those loan officers and closing staff that are entering information into your loan origination system. Ultimately, again, starting with the reporting that you want to have, how is that data getting into your loan origination system? Are your operations team all entering that data in a consistent basis? Are they entering it into the right fields so that when you're pulling that data into your system, it's getting to the right place and driving that reporting? Also, as I mentioned, coordinating with your vendors, making sure you're getting invoices at the level of detail needed to be able to capture that expense information. As an example, if you have appraisals and you want to be able to ultimately capture the cost to originate a mortgage loan, you want to be able to capture those appraisal costs, any credit report fees at an individual loan level, so that when you're looking at your cost to originate, you can see what are the profits and gain on sale you're getting for each loan versus what are the expenses associated with originating each of those loans, to be able to drill down into those details and figure out where you can impact profitability. It's really just about working on the front end to make sure that ultimately the data that you want to track is getting into your accounting system the right way. In terms of building efficiency, ultimately this goes back to the point we made about financial reporting, and the key to good financial reporting has a lot to do with timeliness of that data. Building efficiencies into your accounting system is critical too, to be able to get to a place where you can release those financial results quickly. That's traditionally driven by automated data imports. So a good accounting system that can support mortgage loan accounting will allow for automated import of the data coming from your LOS that you want to be able to get into your general ledger system. So that comes in a couple of different ways. One, if you have the right loan origination system that has automated programming language in the back, so APIs, you can ultimately build a process to where your loan origination system is exporting a data file. It's sitting out on your network, and then your accounting systems can go pick that up even on a daily basis and import all the right data that you need for your general ledger into your accounting system. If it doesn't support APIs and automated data import, a good system will also have flexible data imports. That means you can ultimately export a report from your LOS, and then the flexible ad hoc imports will allow you to rearrange the columns to match the report that comes out of your LOS and be able to seamlessly import that data into your general ledger system. Similarly, those flexible imports, as I mentioned on your vendor invoices, if you're trying to load invoice data or expense data at the loan level, those flexible imports allow you to build an import into your accounting system that will mirror your vendor invoices. So if you have a vendor invoice that only comes from the vendor in one way, and it's column, column A is the loan number, column B is the description, and so on, column C is the amount, you can build your imports in your accounting system so that you can mirror that invoice and easily and seamlessly import that into your general ledger system. What a good accounting system will also do is provide the ability to have loan level reconciliations. So, our clients struggle all the time with being able to reconcile data. If there's an outage or something's not reconciling from your loans held for sale account on your general ledger back to your loan origination system, a key issue is not being able to figure out where the difference is coming from. If you have the right accounting system and have loaded all of your general ledger data at the loan level, it should have reconciliation tools that allow you to see the loans held for sale balance, as an example, or your portfolio loan balance at a loan level, and then compare and contrast that to what's in your loan origination system or your servicing system and so forth. By loans, you can easily pinpoint which loans have the variances and then focus your time and energy tracking down the variances on those loans. Another thing a good accounting system will do is it'll have flexibility to allow for variable data consideration. So what this means ultimately is if you're looking at your loan origination system and you haven't been altogether successful in getting your operations staff to enter data the right way in the right fields, a lot of times we recommend as much as possible building drop downs into your operational data fields so that it's very easy for your loan officers to choose the correct drop down, as opposed to free-form text where everybody can just kind of type in whatever they want. That makes it very difficult to get consistent data that's importable into your accounting system. But if you do have a good accounting system, it will have some variable data considerations in it. So if you do have a free-form text field and you're trying to track state housing agency loans or something to that effect, you can program it to look for certain keywords, and those keywords will then drive where that loan gets tracked in your accounting system. So good systems will have that, building uniformity essentially out of non-uniform data. And then really it's about visibility and access. So does your accounting system have the capability for people outside of accounting to kind of log in and look at their P&Ls? A great example of this is if you have branches, do your branch managers have the ability to go in and look at their P&L on a monthly basis? Giving that visibility and access to the people that are driving the business decisions is critical for being able to drive profitability within your company, because you can have them, review their information in a timely manner and act on things that are expenses that may be getting out of control, as an example, and things of that nature. So a couple things critical for success here is really timeliness of your importing and your reconciliation process. So a lot of clients that come to us and say, hey, it's taking me 15 business days to close my books, how can I impact that? the biggest thing we tell our clients is that, you know, you need to start importing that data, getting all of your loan level data into your system, at least on a weekly basis. For some larger companies, they do it on a daily basis, particularly if you have the ability to do automated imports. But getting that information and that loan data into your system quickly and reconciling it at least weekly really helps cut down on the number of reconciling items that you have to go and track down at month end. That really does put a drain on the timeliness of financial reporting information. If you're waiting till month end to go in and import and reconcile all of your loan level data, suddenly it could take 2 weeks just to track down all of the answers to your reconciling items before you can finalize your financial statements. The other thing we like to say and work with our clients on is streamlining the reconciliation process. So looking at when you're importing the data, when you have errors, or when you have consistently the same reconciling items come up every week or every month. How can we go back and work with operations, work with people within your organization to solve for the root cause? What's causing these issues to pop up time and time again? And if we can streamline the process and make the data a little bit more seamless, it cuts down on that reconciliation time and the manual workaround time as well. And then the other thing really is just setting expectations with users of your reporting. So as I mentioned, if you have branch managers in your credit union and they have access to go in and view their P&Ls, just make sure they understand how often that data is getting updated. If it's not getting updated every week and they're in there every week trying to see, okay, what expenses are hitting my P&L this week or this month, and they're not seeing anything, you know, it's going to cause a lot of questions or a lot of, you know, just a lot of, you know, questions around, is my P&L accurate? What's going on? Why is there no data? So setting those expectations and making sure that your branch managers understand when data is updated and what data they should expect to see at what certain points in the month. If you do all of these things right and you get all that loan level data within your system, you're tracking expenses at the vendor level by loan, you're getting a handle on all of your, you know, cost to originate, it's really going to allow you to create actionable intel for your organization. So what does that mean? Ultimately, you know, we've helped a lot of clients build reporting that drives decision making within their organization. In the current mortgage market, you know, profitability is huge, and understanding and drilling down into, you know, why are certain branches profitable versus other branches? Why are certain loan officers doing better than other loan officers? If we have some that, you know, are generating profit versus some that have a loss consistently month after month, what are the things that we can look at individually by loan officer to see where some thrive and others are struggling? Particularly in this market, you know, back in the COVID days when everybody was just kind of, you know, profitability was good, loan production was really high. There wasn't as much of a need to drill into the details. Most of our clients, the issues that they're seeing right now and have been for the past couple of years is, you know, how can we impact our profitability and how can we make quick decisions? So looking at your net production income by loan in basis points of production, those are all types of key performance indicators that clients like to look at. Also, as I mentioned before, the per loan cost to originate. You know, we at Richey May have a great quarterly webinar. You can compare yourselves to benchmarks. We have it's called the Quarterly Trend Series. We can get you signed up to get on those quarterly webinars, and we go over the trends, what we're seeing in the mortgage market in terms of what's the average per loan cost to originate. You can compare yourself to the industry averages that we're seeing and see kind of where the KPIs are that you're excelling in versus those that you might need to do a little bit more work and, you know, tighten the belt a little bit in terms of where your costs exceeding average. And then also looking at loan production in terms of the products, the types of loan products that you're originating. what's the loan product mix, what's the average loan size, trending, those types of things over time. If you're getting all of that data for each loan built into your accounting system, that system should be able to create reports to give you those key KPIs. See what's driving your business, what's driving your profitability, and how do you impact those for the best. So yeah, with that, I think I will turn it over to Mignon to talk a little bit about compliance.
And Mignon, before we jump in, Kim, I did have a quick question for you for our credit union folks in the audience. For that actionable intel, what would you consider a reasonable timeline for something like that? Is it something you could quickly implement? Are those auditing processes relatively simple? Walk us through.
Yeah, so great question. I think it depends on where you are in your current process. So, and it does take a fair amount of process change. As an example, for vendor invoices, if your AP processing team isn't used to entering invoices in the level of detail that is required to get a good control over your cost to originate, really the change to get your AP staff and get your vendors on board with giving you the data that's needed to enter all the invoices at that level of detail, that can be probably the most time consuming piece. Also just making sure that you have all the data that you need, that your loan origination system is set up the right way and is capturing all of the data that you want to measure. If your loan origination system is capturing all the data and your AP team is really good at entering detailed invoice information, I think getting the right reporting and things like that, it's not really that time consuming. It's really the devil's in the details, so to speak, right? So if you don't have those details, just working with your organization to get the level of detail is the most time consuming piece.
Thanks, Kim. That's helpful context. I appreciate that. And Mignon, I will turn it back over to you.
All right, thanks, Danny. All right, so we're going to talk a little bit about implementing tech from a compliance perspective. So we've talked a lot about accounting systems, and if you're looking to get a better accounting system or any technology within your organization, we're going to talk about some things that you should consider from that compliance perspective. So really, the first thing is that your compliance department has general responsibilities over policies and procedures, keeping things well documented, and they can really help with establishing a procedure for vetting out and procuring these different platforms that you may want to use as part of your tech stack. So they can also provide feedback to help you document your internal control environment and things like that. So, and then obviously testing. The compliance a lot of times is involved in testing, and this could be your compliance department or internal audit, independent testing over, various processes within your organization, including technology, especially as we talk about accounting systems here. So initially, you'll want to involve your compliance and internal audit teams in the third-party vetting process. So as you look to vendors to provide different technology solutions for you, you'll want to include those individuals from compliance or audit on those vetting calls, where you're getting demos and asking questions and all of those things, pricing considerations, control environment of the system, how things work, because compliance can provide that independent advice on some of those system controls. Maybe if there aren't controls that they want to see, they can have conversations around that, maybe even customize the system or ask that tech provider if they're able to change or add different things in the system. It's going to really create those conversations and discussions that need to happen. They can also identify risks early on in the process so that maybe you don't go down that path with that particular tech provider, or you're able to find a workaround through that vetting process, right? So definitely involving them in the process earlier, the better, because if you involve them later on in the process, maybe after you've already contracted with them, it can definitely cause some issues. All right, let's move on to the next slide, please. Thank you. All right, so a few things that compliance can do in addition to the things that we just talked about for vetting the technology providers. During implementation, so after you've already vetted and decided on a particular technology solution for your company and for your credit union, you'll want to, then you begin that implementation phase, right? So during that implementation phase, involve compliance as well. Compliance can help you identify and even decide who the administrator should be of that system. They can help build in segregation of duties controls, restrict change access controls, help you develop a process for approval, for change management approval, or for emergency changes in the system that may need to be made. They're going to be able to help you with all of these things. And then also testing changes, you know, the change management process. They can also help develop a process for helping or for customizing the system. A lot of systems and tech solutions have a lot of customizations that you can build in, and that needs to be logged and you know, you need to keep a history or an audit trail of that, so they can help with that, and then help with that process, building it out and then testing that process for approval for change management, so that you can have that audit trail, know what changes were made to the system. You know, oftentimes we see clients that don't have a log, a change management system or a process in place, and changes are made to the system and it breaks other things that they didn't realize it was going to impact. And then, you know, they don't know which change they made affected, you know, which thing, right? So because they don't have that log and they can't tell, they can't identify, they made too many changes in a certain amount of time, and they don't know which of those changes broke something later on down the road in the system, another process. So very, very important to have that process in place and to test that process and to have that history or audit trail of changes and customizations that are made in that system. All right, we can move on to the next. Yeah, thank you. All right, so post implementation, there are some other things that compliance and internal audit can help with as well. And this really goes back and ties to what Kim was talking about earlier with your data hygiene, basically. You know, you want to make sure that your data is clean. So there are certain things that they can do to help with that. You know, and this again is that independent second look of all the things. You know, Kim, from an operational standpoint, you know, in accounting, they're already looking at all these things, right? She talked about that. Now compliance and internal audit come in and give it a second look. So they can test those input controls to make sure that they're designed to provide that reasonable assurance that your data input was correct. Now, Kim talked about non-uniform data and how variable data considerations can, you know, sometimes be used to be able to, you can kind of, if there's manual inputs and there's that free-form data, you can have a system where there's like keywords or things, and it'll pick it up and it'll normalize that data for you. But having compliance or internal audit come back and test that to make sure that it's working correctly is important. A lot of times the business unit will be able to identify if it's not working correctly too, right? They're the first line of defense. They can sometimes tell, like, hey, this isn't working right. But as a second and third line of defense, you want to have compliance and internal audit come in and test those things as well. For processing controls, that's another thing that we can test. You know, for data processing, so you have your input controls and then you've got your output, and what happens in between there is the data processing. So we can test things to make sure that the processing has occurred correctly. And then again, for the output controls, we can test that to make sure that we've got the expected output, right? We've got the data in, what was processed, and what do we expect the output to be. So we're ticking and tying those numbers. We're doing edit checks and things like that along the way to make sure that all three of these things are correct and you have correct data. All right, let's go on to the next one, which is a little bit more detailed about the auditing and the testing that can be done. So some of the things that we can do post implementation, and what you would want to do within your credit union. And again, this is all to protect the credit union and its members. So what you would want to do from a compliance and audit standpoint is examine your change authorization documents to determine if changes to the system were properly authorized and logged, right? Make sure that that process is implemented correctly and that you know that it's working as intended. They can review procedures for making emergency changes to the system. Sometimes you've got to make an emergency change. And what does the process look like for that? Who's going to authorize that? What does it look like, right? Have that documented and then have compliance or internal audit test it. We can run completeness checks to determine whether all the necessary information is complete, you know, for your data inputs, which again, you know, that normalizing data and all of the different automations and things that you have in place in that system, make sure that all of those are working correctly. And then just performing those edit checks to verify that you have the correct data. I mean, it's data hygiene is very, very important. And so normalizing that data, whether it's numeric or alphabetic or alphanumeric, you know, whatever the format is, making sure that all those inputs are correct. All right, we can move on to the next slide. Sorry, I think it's delayed a little bit. All right, and then for testing processing controls post-implementation, another thing that compliance and internal audit can do is to test that transactions aren't missing or duplicated or incorrectly added, right? You've got things on there that shouldn't be. Again, just checking that data for logical, illogical conditions. You want to be checking those things. You're going to perform posting checks to compare the contents of the record before and after updates. You can use cross-footing to compare the sum of individual components to the total figure, you know, just kind of, again, those looking for illogical conditions within the data. You can use a zero balance check if something's supposed to total zero, you know, making sure that it does. And then run-to-run control totals can be used also to check certain points throughout the data processing, just to see if, you know, if everything's processing correctly. And then you can kind of pinpoint where the issue is if you're able to test it throughout the processing. All right, and then I think we can move on to the next slide there. All right, output controls. This is the last piece that you would want to be able to test here. You know, you've got your input, your processing, and then your output. So your output control testing can include reconciliations. Kim mentioned reconciliations when she was talking, and reconciliations are a key process that accounting department is responsible for, right? And they're doing their own reconciliations, but you want to have compliance and internal audit come in and look at those reconciliations, look at the reconciliation process, make sure that there's segregation of duties, proper approval and second level reviews within the department, within that first line of defense. You can test for the process for journal entries, approvals and postings. Again, ensure segregation of duties there, as well as segregation of duties for the reconciliation process. Usually you'll probably have a different process for processing high dollar invoices and that approval process. So we can come in and test that from a compliance and internal audit standpoint. And you also want to have testing over exceptions that are flagged, you know, make sure that they're flagged for follow-up, they're being researched, they're being reviewed, and that reconciling items or aged items are being researched timely and cleared by the end of the month, or whatever your policies and procedures outline. And then determining whether the totals on those reports are being examined for reasonableness and any illogical conditions. And then you want to also test for dual custody controls where necessary. And Kim also talked about reporting, timely reporting, and this financial reporting really drives a lot of decisions within the credit union. And it's very important that the right people get a hold of that information, that the information is accurate and complete, and that it's timely, because those decisions are being made daily, monthly. You know, there's lots of decisions being made within the organization on any given day, and they need to have timely and accurate information in order to drive those decisions. And I think with that, I'll turn it over to Michael.
It's my turn. All right. Thank you, Mignon. Thank you, Kim. I will be touching on security and third-party risk considerations. This is hyper relevant in the credit union space right now, given the recent statistics and guidance passed down by the NCUA. I think as I heard from the NCUA earlier this week that through August 31st, there have been 1,000 breaches at credit unions in 2024 through August 31st. And 3 out of 4 of those, 75% of them, were related to third-party breaches. And so the data that is leaking is not due to the credit union themselves, but due to a third party that they have that's being breached. And so as we talk through these and the importance of having everything that we just talked about, you know, timely reporting, the right data, and to the right people, right? That data has a sensitivity assigned to it, and it's important to understand exactly what risk we're presenting by bringing third parties into accessing and hosting that data. And so we'll talk about that growing importance of third-party risk. Like I said, it's top of mind. It's one of the more pressing items being talked about in the C-suite and in the board level for credit unions at this point. Data is traversing across 100 different platforms, if not more, in our organizations, hundreds of different platforms. And we rely heavily on our third parties to assist us in providing more efficient, more effective services to our members. And so whether it's cloud storage, payment processing, IT services, some sort of software as a service that's in the cloud, our reliance on third parties is increasing. It's better, it's easier and less expensive to purchase a software than it is to build it yourself. That being said, vendors create new risks due to their weaknesses, potential weak security controls that they have, and maybe they're not necessarily aligned with the compliance requirements for your industry, and specifically for the credit union space. Inside of the financial services industry, and as you hyper-focus down to the segments underneath there, and even specifically with just the mortgage aspects or the lending aspects of what credit unions are doing, there are regulatory requirements that call out the need for third-party risk management. And so there's regulations upon regulations upon regulations that stack up in that arena, and making sure that we're considering what those are and how to enforce those inside of our organizations. Talking about what the third-party security risks are, I'll touch on 4 of them here. Obviously, we've talked about data breaches. There have been over 1,000 documented or known reported breaches from January 1st to August 31st in the credit union space, which is, it seems like a lot, right? It's several per day up to that point. And I think that we'll continue to see that number rise throughout the year. Data is one of the most, if not the most valuable resource in the world. I think it surpassed oil as the most valuable resource about 6 or 7 years ago. And so there is just a need and a malicious activity just focused on stealing data, because data drives other decisions for threat actors. Other third-party risks would be compliance violations. If you are not compliant with your industry's regulations and what's required of you, those tend to come with fines, right? And some more famous ones, right? If you're operating within California, the Privacy Acts in California require strict cybersecurity requirements, and the fines there can range anywhere from $2,500 to $7,500 per record stolen. If you're found negligent in implementing strong security controls to protect that data. Supply chain attacks, this is where we're really really concerned about third parties because we're relying on their secure software development practices to make software that protects the data that we're putting into it, right? We have to upload our data into our third parties' networks and systems in order to get our required outputs, as we talked about earlier, right? The purpose of these applications is to perform something to create an efficiency to give us an output that is actionable throughout our organization. And that data then sits in somebody else's network, somebody else's system. And if there are not secure development practices around those systems, if there's not security protocols within inside of those networks, it can leave your data vulnerable. And then one of the largest risks, right, that can come out of this, and we associate this heavily with ransomware, is downtime, right? Inaccessible data. When we talk about data security, we talk about three core components: the confidentiality of data and the accessibility of data is very important. And so we're focused on those two heavily when we're talking the security risk here. And downtime or inability to access that data can lead to members going elsewhere for services, right? FEMA has defined the cost of downtime per minute in the last year, and so for large organizations, it's about $9,000 a minute for downtime from a system, right? As you move into the medium enterprise, it's about $5,600 per minute, and then in the small business arena, it's about $500 per minute of downtime. Ransomware tends to last quite a long time, weeks on end in some cases, and so that amount of downtime can really add up based on those numbers. Regulatory focuses on third-party risk. There's far too many to list on one slide, much less 10 slides, and so we're touching high level on these, and the NCUA comes into play here as they're also defining some requirements for security through their ISE rules. And so GLBA, FFIEC, these are all financial institution acts. The GLBA heavily aligns with the FTC as well on their cybersecurity rules. And then for any financial institutions operating inside of New York, the NYDFS Rule 500 impacts organizations. It's a very intense regulation for financial institutions because it requires more than almost every other framework and any other regulator requires. And their Rule 500.11 defines what organizations need to perform around third parties to make sure that they're compliant, which is enforcing all of the NYDFS cybersecurity controls to those third parties, making sure that they too are aligning with it. This tends to be a costly endeavor, right? As we have to not only worry about the internal security controls at our organization, but enforce those at our third parties. And so the amount of time required to do the vendor management and the due diligence, as we'll talk about on the next slide here, is can lead to a much higher level of effort. And so making sure that we have a thoughtful due diligence process to thoroughly assess our vendors is important. Oftentimes you'll want to be looking for compliance attestations like the SOC 2 through the AICPA or the ISO 27001, which is an international standard for cybersecurity and security controls inside of organizations. But going beyond that, just because those exist inside of organizations does not mean that they are or are not secure. It just means that somebody is attesting to the controls defined for them. And so making sure that you go beyond that from a due diligence perspective, asking questions, requiring evidence, things along those lines from a vendor due diligence perspective. Moving on to contractual safeguards, right? Just because you are defining or just because you're doing your due diligence and researching the security controls inside of a third party does not mean that they will never get breached, right? The old colloquialism that we use in security is it's not if but when. I don't love that, but we've moved beyond prevention in the cybersecurity industry and started talking more about resilience. So like when we do suffer from a breach or have a cybersecurity attack or incident, how resilient can we be? How can we recover from it quickly? How can we move on and stop that breach in its tracks rather than being impacted fully? And so with that, contractual safeguards really come into play, making sure that you're working with your third parties contractually to make sure that you have access and the requirements needed through a legally binding contract to overcome a breach. If you're seeing your data presented to you from a dark web location and you can tie that back to a third party, you need to be able to get access to their logging and their incident response plans and integrate into those to make sure that you have the capability to quickly and effectively move forward from there. There are a lot of legal aspects to the contractual safeguards, so making sure that you have your compliance and legal teams aligning with what your requirements are from a regulatory perspective and requiring those of your third parties from a legal perspective inside of contracts is highly important. Monitoring for cyber attacks, and this isn't just internally, right? That is a requirement inside of financial institutions as well as continuous monitoring, but it also requires that your third parties have continuous monitoring and that you continuously monitor them and continuously do your due diligence year over year, or even more frequently. And then last is the incident response and business continuity. This is where we're talking about recovering from downtime. If a breach is identified, do you have an incident response plan that you've tested and employed inside of your environment so that when something does happen, you know who to call, when to call them, how long you can be down for in certain situations, and making sure that your incident response plans include your third parties in that, and you have contacts at those third parties to bring those in when needed. I threw a slide in here for some frameworks to follow across the board. A lot of regulatory requirements align with these frameworks, specifically the NIST CSF, the cybersecurity framework. And then the NIST cybersecurity framework pulls from a larger framework called the NIST 800.53 framework. The NCUA aligns with the 800.53 framework from an IT and cyber perspective and requires credit unions to implement the controls listed inside of that framework. The rest of these also come into play in our industry focused as well. The Federal Financial Institutions Examination Council is a maturity and risk assessment for financial institutions, specifically depositories that have ATMs as well. And so it builds out a risk score for financial institutions. If you're in New York and you're licensed for financial activity there, NYDFS is one to follow there. A more comprehensive one that takes into consideration all of these is the Cyber Risk Institute. Googling the Cyber Risk Institute, it is specifically focused for financial services, and it crosswalks amongst all these different frameworks. So if you align with one, you can see how you align with others, including the Center for Internet Security at the bottom here. So this is really just more of a helpful slide. Even if you're not involved in the security aspects of your credit union, you know, sending this along to the right people to see if and where you align, and even provide them some information to move forward there. Ways to aid in your third-party management is by leveraging tech, and we don't talk heavily about it in this slide deck, but vendor risk management platforms, we wanted to remain agnostic. There are a handful of platforms out there that automate the processes required to do your vendor risk management. It performs vulnerability scans on those third parties. It sends questionnaires and collects documents. It even keeps databases of organizations that have already been assessed by other organizations so that you can efficiently move through organizations a little bit faster by having some pre-canned answers come through and then make some quicker decisions to bring the right platforms into your organization. Leveraging a security information and event monitor, a SIM or a SIEM, depending on who you ask, is very important. So any solution that you're implementing should have some logging, and that logging can be sent to your security information and event management system to aggregate that and then correlate it to other things happening in your environment and alert you proactively of anything that may be anomalistic or malicious in your environment. And then last is encryption and secure access. We've been hounding on this in the cybersecurity industry for a long time, and everybody's well aware. Multi-factor authentication is vitally important for any applications that we're logging into. The common passwords of the 90s and the 2000s are not good enough anymore, and we needed multi-factors to get logged in. And so making sure that those are implemented is important. Things to consider when developing a vendor risk management program: take a risk-based approach, define what your risk tolerance is, define what the sensitivity of data going into the vendor platform is important, right? If it's PII, if it's things like social security numbers, first name, last name, address, bank account numbers, things like that, it has a higher sensitivity than just like a loan number or one data point like a first name. And oftentimes tokenized data is the way to go in that arena. And then the criticality of that service, right? If your organization cannot operate with that service, then it has to be a higher priority to recover in your environment, and the risk is higher due to that. Test for resilience, require and review penetration testing and tabletop exercise results of your third parties. This is not uncommon, and if the answer you're getting back from a third party is we haven't done that, it might be time to move on to the next best vendor, because these are requirements and standards in the cybersecurity aspects of every industry. If you're not performing a penetration test and performing tabletop exercises, you're opening up your organization to a much higher risk. Create collaborative partnerships, right? Just signing on for a software solution and then walking away and never having access to talk to somebody is not a great way to run with that. Making sure that you have open communication with your vendors so that if something does happen, you can reach out and quickly and effectively get the information you need in the event of a cyber attack. And then the last thing that we'll touch on is really that exit strategy. Is as you're bringing vendors in, creating an exit strategy for that vendor from the get-go, understanding what requirements you have for termination of those contracts, how to disengage and make sure that your data is removed from their systems when you do disengage. I'd say that's one of the more common aspects that happens is organizations will upload data into third parties, and once they stop using that third party, that data is consistently stored and backed up at that organization for for infinity at this point. And so that leaves that data at risk down the line when people forget about it, organizations dwindle or grow or get acquired, and then there's not a lot of focus on that. I'll move on to the next slide and we'll talk just key takeaways for the presentation. I think Kim started it off by saying, begin with the end in mind when you're looking at financial applications and anything to manage the financial aspects of your organization is really to what is the end goal. And in this case, it's really creating actionable intel and financial reporting, or making sure that those solutions can do that for you. And then moving on to the implementation and being thoughtful for that, as Mignon talked about, right? Having a thoughtful approach for change management, testing what goes into the application, testing what comes out of the application, making sure that we're considering changes as an organization and able to back out of those changes. And then looking at a secure approach from that perspective as well, when you're bringing vendors on, making sure that you're doing your due diligence and making sure that their security aligns with what you need and you are required to have as well. From there, I'll dive into questions, and it looks like we have a couple questions, and I'll start for you first, Kim. The first question is, if companies don't have an accounting system that is built for loan level accounting, how do they track and reconcile their data?
Yeah, so I mean, people use Excel spreadsheets, so old school, right? And in Excel spreadsheets we all love, especially if you're an accountant like me. I mean, there's a time and a place for a good Excel spreadsheet, but driving your general ledger and your accounting for mortgages is not the place for an Excel spreadsheet. So they're very prone to manual error. You know, the ability to track and maintain all of the general ledger entries for every single loan number in an Excel spreadsheet. You know, that Excel spreadsheet gets pretty large, can break, or you know, cause all sorts of errors and issues, and kind of touching on, you know, what Mignon might say about Excel spreadsheets from a compliance standpoint is they're a lot more difficult to test and audit as well. So anytime you can get that level of data into your system and out of an Excel spreadsheet, there's also data validation points that can be built into the system. So it eliminates the manual keying errors. When you load the data into your system directly from your LOS, it makes sure that all of your loan numbers are accurate. And then the other data validation point, when Mignon talked about her controls, data validation is probably one of the most important. And if you have all of this built into your accounting system, it won't allow you to enter the wrong loan number, because it'll say that loan number doesn't exist in our system, so we can't let you enter any data. So, you know, Excel spreadsheets is really all we've seen outside of a good loan level accounting system, and can be done, but the larger you get, the less sustainable that is as well.
Perfect. And then for you, Mignon, is it easier or harder to test accounting processes if Excel is used versus a platform like LoanVision? I think we just touched a little.
Definitely harder in Excel. It can be done, but it's not ideal. And what we've seen, just last year or maybe a year and a half ago, I had a client that, their payroll and all their accounting, everything was in this very large Excel file, and it had been built years and years previously. The person who built it was no longer with the credit union, and the people using it didn't really know how it worked, because it was so complicated, and just there was so much to it. So it was very difficult. Like Kim mentioned, they can break, like things happen with Excel, with the formula. Maybe somebody manually, deletes something somewhere along the line, and you can't find it, and you don't always know how to rebuild it or fix it if the person or the owner who created that is no longer around. So it can be very, very challenging for organizations and credit unions to be able to keep up with that complicated Excel file, and can cause a lot of issues down the road for sure.
Yep. And from a data security perspective, the Excel files aren't always the best route either. And so I want to thank everybody for tuning in today. We hope you found this information valuable. As a reminder, we'll send an email with the slide deck and recording in the next couple of days. Please remember to fill out the survey that appears on your screen after you exit the webinar. Your feedback is very important to all three of us and both organizations that deliver this webinar. And we use it to craft future webinars. So please enter and take that survey at the end. If there's something you want us to cover in the future, please let us know. And thank you again, and have a great rest of your day.
Thank you.
Thanks.